investments, but results of the Blue Ink All South African Hedge Fund Composite, which tracks the performance of around about 100 hedge funds in South Africa, has shown that this asset class continues to offer investors significant protection from volatility during the current market turbulence. Kevin Ewer, portfolio manager of Blue Ink Investments, joins me now so we can take a closer look. Kevin, thanks so much for your time this afternoon. Well, perception, it seems very different from the reality that's actually playing out. Just how have hedge funds, broadly speaking here, performed against other asset classes since launching a decade ago?
Well, Alicia, thanks for having me. It's been 10 years really the extent that the South African hedge fund market's been running, and they've actually done spectacularly well. If you were to look over that period, they've actually outperformed all asset classes. I think what's more important though is how they've done, in bear markets, in particular, where they've protected capital exceptionally well and generally made money. Even in 2008, the average fund was up around 2%. When equity markets were down sort of 25 to 30%.
Well, if we hone into this past quarter, which you can see up on screen there, I mean, equities have outperformed hedge funds, where during the period, the average South African hedge fund posted a gain of 2.3%, while the JSE All Share delivered a close on 4.5% gain. So what's the investment merit that we're looking at here?
Well, I think the key thing really is the volatility at which the returns will be done out of the hedge fund market in South Africa. And if we were to extend it beyond the first quarter into May, you would see the average hedge fund is probably going to be flat to down maybe sort of 0.2, 0.3% this month, whereas equities have been between 5 and 10% down this month. So it's been a lot more of a smoother ride. Year to date now, equities are going to be down and hedge funds will still be up.
How exactly have hedge funds managed to offer investors protection from the volatility during very turbulent times and, greater protection from that downside risk?
Well, I think the key thing, the best edge any hedge fund manager offers is being a risk manager. And part of that risk management is looking at levels of the market and hedging when appropriate. And I think in recent times, guys have been skeptical about the levels of the market and have been, not taking a lot of directional risk on their portfolios and have been hedging properly. And consequently, going into sort of May, where the volatility has really exploded, guys have been in a good position to protect capital. And what you also get in this environment is a lot of excellent investment opportunities opening up, which creates great potential for future returns.
One would assume this would lead to much more activity on the hedge fund front, especially now with all the uncertainty and all the volatility we're seeing on the markets, where investors start to see this as a safer entry point into the market. What kind of activity are these hedge funds seeing?
In terms of investor flows, it's generally been fairly quiet, and I'm sure we can chat a bit about the regulation in a second. I think guys are quite happy with that at the moment, simply because one's concentrating on protecting capital, making money at the moment. But flows have been fairly quiet over the last year, which is not too surprising as well, given the strong equity markets up until May.
Let's take a look then at perception surrounding regulatory issues, because you've touched on it here. Pertaining to regulation, many still hold the view that the unregulated nature of the industry leaves it riskier and more open to abuse. Is that necessarily the case?
I think it is fair comment to say, when something is unregulated, there are people who could come in who could abuse the system. That's 100% correct. However, the hedge fund industry in South Africa has got incredible self-regulation. As a fund-to-fund manager, I receive daily trades from every single fund we invest into. We can see exactly what they're doing. And the guys also have proper mandates in place which prevent them from taking excessive risk. They all outsource their administration. They all outsource their custodianship. They all use prime brokers. So it's very, very difficult for someone to actually get involved in any fraudulent activity. I think the other thing, generally the hedge fund industry in South Africa would welcome formal regulation.
Yeah.
You now need to be a regulated Category 2A license holder with the FSB to run a hedge fund in this country. But there's still no regulation on the product. It would definitely make our lives easier, as it would sort of halt the perception that there are a bunch of guys doing strange things out there. when in reality there's nothing to hide in the hedge fund industry.
Where, in fact, as you said, we are seeing a more disciplined approach emerge, right?
That's correct, yes.
Okay, let's
And
check.
in fact, I would just say it's emerged over the last 5 or 6 years. I mean, South African industry has always been very transparent and very disciplined. I think you're seeing a bigger change over the past 2-3 years in offshore markets where the guys are being forced to become a lot more transparent with what they're doing there.
So with all of that being the case, and with diversification still the key to a successful portfolio, what element of their portfolios are you advising investors to let hedge funds comprise?
Sure. That's always a difficult question to answer, because of the unregulated nature. But I think the key thing is that they've got a role to play. Whether it's 5%, 10%, 15%, 20% of their portfolio is up to each individual investor to decide. But I think the key is they've got a role to play because they do take out the timing element of one's investments by giving it a smoother ride. And what most investors find difficult is getting market timing right. 95% of professional investors don't get it right. So, the man in the streets got very little chance of getting that right. And something which offers him a fairly steady return is ideal in any portfolio.
So this one way of taking the timing element out of the game.